So I wanted to touch briefly upon the traditional way of considering refinances and why I think that it's not necessarily the most beneficial way of approaching a refinance. Now, the traditional sense is if my rate decreases and my payment decreases, then I'm going to take the difference in the closing cost based on the difference in payment and compare that to, divide that out by however many months it's going to take in order to recover that difference. Now, that's a good idea, but it's also a very elementary approach. If you take that approach, you're going to end up running into all sorts of scenarios that might not necessarily be in your best interest if you consider all the different factors that go into refinancing. Because unlike a purchase, when you're buying a house, you're buying a house. On a refinance, you're really taking into consideration a whole variety of different options. And we want to make sure that you understand that the difference between making a profit and how to make a profit by leveraging your real estate that you own, which is in most people's cases it's the largest investment and the largest piece of equity that they have, then we want to consider what happens when we sell the house. What happens if we sell the house sooner? So just simply taking that, closing costs are X divided by this amount, that's a very simple way of approaching it. And quite frankly, I think the majority of people that got into the business, that's the first way that you learn how to do a refinance. Now, once you start thinking of it from a financial advisor type standpoint, then you're really looking out for your client's best interest, short term, long term, and that involves asking a lot of questions. So let's just dive into some of the questions that we're going to ask and understand that we're not trying to pry, but we don't want to put you in a situation that's not going to be in your best benefit based on your goals, not somebody else's goals, and not some cookie cutter approach.